Hello friends, we will continue with our discussion on admission of a partner. So we were discussing about admission of a new partner, right? And in the last lecture we started with a new topic, that is revaluation of assets and liabilities. Why we have to revalue our assets and liabilities? Because we should not be putting the new partner to any advantageous position or any loss position. Anything which belongs to a period before the new partner joins the firm belongs to old partners in old ratio. If an asset has an appreciated value, right, that value appreciated in the period when new partner was not in the picture. This revaluation we are doing on the date of admission. So if on the date of admission there is an appreciation in the value of an asset, that means that asset appreciated in the period before the date of admission, right, when new partner was not in the picture. Otherwise also I say that anything, any profit, any loss, any income, anything which belongs to a period before the admission of a partner belongs to old partners in old ratio. Clear? So we discussed about the various journal entries, that if an value of an asset is appreciated, how to record that. If the value of liability changes, how to record that, right? Now in this lecture we will see some practical problems on that. Let's see a practical problem. Rohit and Bal, sharing profits in the ratio of 5:3, had the following balance sheet as at 31st March 2016. Goodwill is appearing in the books at 30,000, building, plant, furniture, debtors, bills receivable, stock and bank. On the liability side, we have the capital accounts of Rohit and Bal, then we have journal reserve, creditors and bills payable. On 1st of April 2016, they decided to admit Rahul into partnership, giving him 1/5 share. He brings in 50,000 as his share of capital. The partners decide to revalue the assets as follows. Goodwill is to be revalued at 50,000, plant 25,000, debtors 31,000, stock 32,500, building 40,000, furniture 2,000, bills receivable 12,500. You are required to show the journal entries and prepare revaluation account. Now friends, see, very simple question. We just have to revalue the assets. One important point here is, while we were discussing about goodwill, I told you that as per accounting standard 26, any intangible asset including goodwill is not to be shown in the books. So if there is any goodwill appearing in the books, that has to be written off among old partners in old ratio. See, there is a goodwill appearing in the books at 30,000. This goodwill we will have to write off. Then what is the purpose of giving here the revaluation of goodwill at 50,000? What is the purpose of it? This is just for the purpose to calculate the premium for goodwill to be brought in by new partner. This is for the purpose to calculate the amount of premium for goodwill to be brought in by new partner, the amount of compensation to be brought in by new partner. Clear? So this goodwill we will not show in the books. So first of all, we will prepare the revaluation account. First of all, will prepare revaluation account. Particulars, amount, particulars and amount. Right. So let's see what is to be revalued. First of all, they say the plant is revalued at 25,000. What is the original value of plant? 27,000. There is a decrease in the value of an asset. How to record that? What will be the journal entry? If the asset value decreases, what will be the journal entry? The journal entry will be revaluation account to that asset account. The asset account will be credited, not debited. So, with how much this plant account be credited? I will say to plant account 2000. Clear? Next, debtors 31,000. What are the original debtors? 32,500. Again 1,500, there is a decrease in asset. So I will say to debtors 1,500. Clear? Next, stock 32,500. What is the stock originally? 22,500. There is an increase to the extent of 10,000. The stock value is increasing by 10,000. So the journal entry will be stock to revaluation account. Clear? Next, building 40,000. Originally 34,000. Increase in the value of an asset to the extent of 6,000. So I'll say by building. What will be the journal entry? Building account debit to revaluation account 6,000. Next, furniture 2,000. Earlier the value is 4,000 in the books. Decrease in value. I'll say to furniture 2,000. Clear? Okay. Next, bills receivable 12,500. Again there is a decrease in the value to the extent of 2,500. So I'll say to bills receivable account. How much? 2,500. Now see whether this side is more than this side. Increase in the value of an asset is more than decrease in value of an asset, then what will happen? It will be a gain or a loss. If you are receiving rupees 5,000 and you are losing 2,500, whether it is your gain or loss, it is obviously a gain. Now what you are receiving? You are receiving 16,000. What you are losing? You are losing is 4 to 6 to 8,000. So it is a gain of 8,000. So I will write to gain on revaluation. Now this gain belongs to whom? To the partners. To which partners? Old partners or to all the partners including new? Friends, this gain on revaluation belongs to only the old partners because this value appreciated or depreciated during the period when the new partner was not in the picture. So this gain on revaluation belongs to old partners in old ratio. What is the old ratio? 5:3. That means 5,000 and 3,000. So the total is 8,000 and the total of the account is 16,000. So this is our revaluation account. Clear? Now, let's see the journal entries now. It's very easy. Now we can pass journal entries from this revaluation account only. First of all, I will talk of the appreciated stock, appreciated assets. I will say stock account debit, building account debit to revaluation account. So my first entry will be stock account debit, building account debit to revaluation account. What is the amount of stock appreciated? The stock appreciated by 10,000 and building appreciated by 6,000. So the total credit to revaluation account is 16,000. Next, the assets which depreciated. Revaluation to plant, debtors, furniture and bills receivable. So I'll say revaluation account debit to plant account to debtors account, furniture and bills receivable. How much is the amount? The plant depreciated by 2,000 rupees, debtors by 1,500, furniture by 2,000 and bills receivable by 2,500. Plant by 2,000, debtors by 1,500, furniture again by 2,000, bills receivable by 2,500. So the total is 8,000. Now the profit on revaluation will be distributed among the old partners in old ratio. Clear? So the journal entry will be revaluation account debit to Rohit's capital account and to Bal capital account. How much is the profit? 8,000 will be distributed among old partners in old ratio, that is 5:3. This is old ratio of the partners. Clear? Now, don't forget about the goodwill. First of all, the goodwill is appearing in the books at 30,000. This we will write off among old partners in old ratio. What will be the journal entry? What is going to be the journal entry? The partners' capital accounts will be debited because we are writing off an asset. The asset account will be credited, and this will be done through old partners capital accounts in old ratio. In which ratio? In old ratio. Writing off goodwill in old ratio. What is the amount? 18,750 and 11,250. Clear? Now, the new partner must also bring the premium for goodwill. He is bringing capital, but he is not bringing premium for goodwill. See, the question says he brings 50,000 as his share of capital. We have to pass this entry also. This will be bank account debited to Rahul, who is the new partner. This is for capital brought in by Rahul. Now, he is not bringing goodwill, but we have to take the effect of goodwill. Goodwill is revalued at 50,000. His share in the profits. See, it is given that the Rahul is admitted into the partnership, giving his 1/5 share in the profits. Clear? Giving him 1/5 share in the profits. What is the value of goodwill? 50,000. Now you know how to calculate the amount of premium to be brought in by new partner. Let's see. Amount of this you can show in the working notes, okay? Amount of premium to be brought in by new partner. Who is new partner? Rahul. This is total goodwill multiplied by Rahul's share in profits. Now, what is the total goodwill? On the date of admission, the goodwill is 50,000. This is given to us that the goodwill is valued at 50,000. And what is the Rahul's share? 1/5. That means the premium to be brought in by Rahul is 10,000 rupees. Now this premium, he is not bringing this premium. We have studied in the lecture of goodwill that if he is not bringing his premium for goodwill, we although has to recover this goodwill, this premium ultimately from the Rahul only. So what we will do is, what will be the journal entry? The journal entry will be Rahul's capital account debit to the old partners, to Rohit's capital account and to Bal's capital account. Now, in which ratio this amount of 10,000 is to be distributed? In sacrificing ratio. And I told you, if only the old ratio of the old partners is given and the share of profit of the new partner is given, we are not given the new profit sharing ratio, then sacrificing ratio will be equal to the old ratio of old partners. That means the sacrificing ratio in this case will be 5:3. So this premium for goodwill will be distributed in the ratio of 5:3, amounting to 6,250 and 3,750. Clear, friends? So in this we have covered the revaluation aspect also as well as the goodwill aspect also. Clear? So be careful with the goodwill aspect. Remember, any goodwill appearing in the balance sheet is to be written off. Why? As per accounting standard 26, which deals with the intangible assets, which says that goodwill on admission of a partner is not to be shown in the books. Books means is not to be shown in the balance sheet. So this goodwill which was appearing in the balance sheet, we write off among the old partners in old ratio. Right? Why this goodwill is given as revalued amount at 50,000? Just to calculate the premium of goodwill to be brought in by new partner Rahul. Right? So be careful, especially with goodwill part. Revaluation part I know is very easy, you all can deal with it, but the goodwill part can be tricky. So I would suggest, friends, first go through the goodwill part thoroughly before moving on to the revaluation part. You must have a good knowledge of the goodwill part. In case of admission of a partner, it is a little bit tricky. We have various cases, and in these type of questions we have to identify that this problem lies under which case. So you must go through the goodwill part first, then move to the revaluation part. Clear? Go through the goodwill lectures. Then you can easily understand this revaluation part. Now friends, one small point here. If they ask you to prepare the balance sheet, how will you do that? You have passed the journal entries here. You have prepared the revaluation account. I always tell you that in case of revaluation, always prepare the revaluation account first, whether they have asked for it or not. If they haven't asked for it in the question, prepare it in the working notes. Show us the working notes. No problem. Prepare the revaluation account, pass the journal entries. Now what you are going to do is, see this balance sheet you have. Now if I talk of a new balance sheet, if you have to prepare a balance sheet on 1st of April 2016, what will be the balance sheet? This goodwill we have already written off. So this goodwill will not appear in the books. Building we know value is 40,000 now. Right? Plant 27,000. Furniture 4,000. Debtors 32,500. Let's prepare a small balance sheet here. If they ask you to prepare balance sheet as on 1/4/16, that is the opening balance sheet after the admission of a new partner. So what will our balance sheet look like? Let's see. Here we have liabilities and amount. Clear? See, goodwill. Will the goodwill appear in the books? No sir, we have written off the goodwill. We will not show this goodwill in the books. Cancel. Building, yes sir, we will show building in the books. At which value? At the revised value of 40,000. So I will say building at 40,000. Plant, yes sir, we will show the plant at which value? At revised value of 25,000. Plant 25,000. Clear? Furniture, yes sir, at 2,000. Furniture at 2,000. Next, debtors. Debtors at 31,000. Clear? Then bills receivable. Yes sir, we have to show the bills receivable at 12,500. Clear? Then stock 22,500. No, 32,500. Appreciated value, the actual value on the date of admission. Bank, yes, this is interesting. Now we are given bank as 11,000. Is there any other entry relating to bank? Yes sir. What will be the bank? 50,000 we have received as capital in bank account. 50,000 we have received as capital in bank account. So what will be our bank? If I talk of bank will be 11,000 originally plus 50,000 we have received as capital from the new partner. So our bank will be 61,000. Clear? Be careful about this. Clear? Now, if I talk of the liability side, anything left on the asset side? No sir, everything covered. Sir, goodwill of 50,000. Friends, not to be shown. As per accounting standard 26, goodwill on admission of a partner is not to be shown in the books. Be very careful about this thing. Clear? Now if I talk of the liability side, journal reserve, yes sir, 28,000. Okay. Although we'll talk of this journal reserve in the coming lectures. This journal reserve will not appear in the balance sheet. This will be distributed. For the time being, we haven't discussed it, so we will take here. Then creditors, yes sir, as such 20,000. Bills payable 8,000. Creditors, how much creditors? 20,000. And how much are the bills payable? 8,000. Now what is left? The capital accounts of the partners. Capital account of now 3 partners, Rohit, Bal and Rahul. Now how to get these figures? For this you will have to prepare partners capital accounts. This you can prepare. This we have discussed in the very first chapter of partnership, how to prepare the partners capital accounts. We have the opening balances of capital as 80,000 and 40,000. Then we have a few transactions relating to the partners capital, like this revaluation profit will be credited to the partners capital account. Then this goodwill will be debited because we are writing off the goodwill that is appearing in the books. Then this premium for goodwill from the new partner will be credited. After that, whatever balance you get of the partners capital accounts, you will write down here and your balance sheet will tally, 100% tally. Right? So be careful with all the aspects given in the question, especially the goodwill part. I am again repeating, you must go through the goodwill part thoroughly before moving on to the revaluation part. Right? Go through the goodwill part first. So if they ask you to prepare this balance sheet, you will have to prepare revaluation account, you will have to prepare the partners capital accounts, nothing else to do. Your balance sheet is ready on the date of admission of a partner. Right? So now in the next lecture, we will discuss about this revaluation of assets only. We have one topic that the book values are not affected. That means we have to show the assets and liabilities at book value only. Then how to treat the revaluation? Right? The assets and liabilities in the new balance sheet are to appear at book value only, but we have to revalue our assets and liabilities. Otherwise, the new partner will be at advantageous position. Then how to treat that? Right? How we will be treating any profit on the revaluation of assets and liabilities if the book values are to be not affected. Right? This we will see in the next lecture. That's all for this lecture, friends. Thank you so much.